We are 30 minutes away from the opening bells, Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning, Asian stocks extending a global rally with cooler U.S. inflation reinforcing bets on Fed cuts. As early as September now, major equity benchmarks setting records worldwide as Treasury yields retreat.
Right, Saturday to reopen here in Hong Kong. We'll be watching the property developers as after, of course, Bloomberg revealed potential plans for government purchases of unsold homes. Tech is in focus too. JD.com and Baidu set to report earnings today.
Plus, Vladimir Putin arrives in Beijing for talks with President Xi as Russian forces press ahead with a new offensive in Ukraine.
Welcome again to the show. We're locked and we're loaded ahead of the open. As you can see, it's a very busy next 2 hours or so here on shows. Underscoring everything really is this massive risk rally taking place across markets. Hong Kong's reopening as well. We'll see what the gap higher potentially looks like today, although you might get an offset in terms of Alibaba, of course, one of the heavier weighted ones. More on that in a moment. JD.com, Baidu are leading the earnings charge today. We'll see, of course, what reaction is going to be across these property counters. In addition to the news yesterday, there is one district, and we'll talk more about this later, one district in Hangzhou has actually now decided to go ahead and purchase unsold homes. More on that in a moment, as we mentioned there as well. Okay, junk bonds also in focus on the back of that other story as well. Shermao A shares will be delisted. That's the news there. More on that in a moment. But apart from that, we're looking at this risk rally, Yvonne, taking place.
Ooh, relief. Relief is what
Finally.
you're seeing right now. So the first time in 6 months we've seen that U.S. inflation print actually soften here, and that really has sent this risk rally as we talk about extending into the Asia session. We talk about the records that were hit in Europe a little bit later on, but U.S. futures, look at that. We're still punching well above that 53.40 level here right now after, of course, the S&P did notch that 23rd record of the year. So you're seeing that bid across equities. Treasury the yields also decline across the board here in some of these sovereigns here as well, even when it comes to these JGB market, despite some of the speculation on tightening and the like of late here. So you're watching that Aussie 10-year yield that's down some 9 basis points. Japan yields are also ticking lower by 2 basis points on the long end of the curve. Dollar yen also seeing quite a bit of strength here, just given the biggest dollar drop we've seen in basically this year on the back of that CPI print. So you're seeing 153 levels for dollar yen here right now, and the Bloomberg commodity spot index is basically at those 1-year highs right now. So everything you're seeing when it comes to oil prices, that's ticking up a little bit higher. Copper, you take a look at the LME. We're basically now at 2-year highs. I think we're just about 3% away from reaching those records that were hit back in April of 2022. And gold also continuing that rally here. We're back above that 2,400 level after, of course, this inflation print as well. You take a look at what treasuries are doing here right now. We saw basically 10 basis point drops when it comes to the 10-year. The 2-year was pretty similar as well. Looks like we're extending that rally here this morning in the Asia session. We're back to 470 levels for your 2-year yield. Swaps are now, we've basically priced and repriced once again from 1 cut to now 2 after that CPI print as well. So now they're saying maybe as early as September in the fall, we could be seeing those rate cuts. In terms of the setup, of course, we talk about this Hong Kong reopen here. So Dave mentioned that we might see that catch up in the property stocks. Tencent, Alibaba, JD, Meituan also reporting, or Baidu, I should say, reporting on Thursday as well. It looks like we're set up for a pretty good open here this morning. 720, still seeing some strength on the renminbi here this morning, Dave.
Yeah, a big drop there in the US dollar. That helps. That helps. It helps a lot. Okay, let's get some commentary here on this inflation print coming through as well. Really, the sense we're getting in markets is as early as September. But Neil Kashkari had other things in mind. He basically says, hang on a minute. The Fed might need to keep rates where they are for a bit more. Have a look.
How much downward pressure is monetary policy putting on the economy? That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
For more, let's bring in our Asia economics correspondent, Katya Dmitrieva, to tell us about this CPI print. Certainly it was a relief for markets here right now. We look under the hood. Is it enough to warrant rate cuts now?
Yeah, well, it was good news at least. That's a good first step in sort of the process of sustainably getting inflation back down. I think economists, Fed policymakers really wanted to see this. Is it sustainable? Everyone so far has said, you know, from Wall Street economists to Kashkari, we just heard Goolsbee as well said, hold on. This is one report. Yes, CPI was weaker than expected. Yes, retail sales as well were weaker than expected. But this is not going to be the be-all, end-all. We need at least one more report, at least two more reports to get this trend going.
Talk to us then about the sticky components or the sticky parts to this inflation report.
Yeah, I think rent. Rent is the number one thing. I mean, economists have been watching that for now 6 months, you know, reading in notes and speaking with economists, wanting to see that come down quite a bit more than where it is now. We did see some good news. There is a bit of sort of disinflation going into the rent prices right now as a component of CPI. That's the biggest chunk of the CPI basket. That's why it's so important. Unfortunately, it's not cooling to an extent that would warrant the Fed to sort of sit back and say, okay, this is the services part of CPI is now, you know, kind of going back down. I think the services is still quite sticky. We did see some improvement in other categories, though, within the services component. It's just that rent part that's been really tough to get down.
Yeah, there we go. Rent plus Supercore. Thank you so much, Katya Dmitrieva, our Asia economics correspondent there. Markets hear what they want to hear, don't they? Mary Nicola is with us right now, MLife strategist. Mary, we woke up this morning, record S&P, record Dow Jones, record NASDAQ, record in Europe. We're two-year highs here in Asia Pacific. How long does this rally, this feel-good factor play out, this pixie dust across these markets play out?
Yeah, for now, especially because we don't have that much data going forward, it looks like the everything rally continues. So, for example, next week we'll have NVIDIA, and NVIDIA will be obviously important because everyone's watching the AI stocks. But for now, the market's looking for a reason to rally, and they got it. They got it not only from CPI, but from retail sales, both of them indicating that there's some softening in the U.S. economy and that we're inching a little bit closer to a Fed rate cut. However, I think the key thing to keep in mind, it is just one reading, and the Fed will need a trend before they start signaling that they are going to commence with their easing cycle.
Obviously, we're seeing a lot of tailwinds. I'm guessing with these Hong Kong markets reopening today, obviously the tech earnings story is one key theme, but also our scoop about China finally tackling this housing glut that we're seeing. Is that going to help also this Hong Kong rally continue?
Absolutely. I think the Hong Kong rally is waking up to a nice mix, not only from a U.S. tailwind, but from a China tailwind as well. And if we start seeing more of these news coming out about, you know, targeting the supply glut in on the property side in China, targeting the property sector and fixing one of the biggest drags on the Chinese economy, that'll be absolutely crucial for Hong Kong stocks and for China stocks as well. So for today, they get a nice little boost from two different tailwinds from two different sides of the globe.
And Mary, just very quickly, final question. Any specific or particular risks to watch amidst this sort of everything rally we're seeing at the moment?
Yeah, I think the key thing right now to watch, especially with what can cool this everything rally, is some of the Fed speak. So Fed speak is not only coming from the next day or so, but also into next week. Also the FOMC minutes. So there's a few things that could actually stall a little bit, as well as earnings. So for example, you still get Walmart earnings. You could see some more cracks in the consumer as well. And so when you see that deterioration, that might actually be a hindrance rather than support for the equity market. So it needs to cool. So the economy needs to cool. Just it depends what's the degree of cooling, so to speak.
Mary, thank you. Mary Nicola getting us warmed up here for the trading day ahead. Thursday session in Hong Kong, in China, 20 minutes away. We're looking at TSMC just very, very quickly here, coming online over in Taiwan. So 1.7% to the upside here. So tech has been bid. We're also getting some reports of an explosion reported at the North Phoenix plant at TSMC. So more on that more details on that once we do get them. But for now, it seems like this disinflation theme is trumping most other risks out there.
Still ahead, we're going to get a preview, of course, of those Chinese tech earnings with a focus on Baidu's progress in AI, while JD.com's deals with rising competition in the e-commerce space. We certainly saw that in those Alibaba earnings. And we're counting down the open of trade in Shanghai, Shenzhen, and the reopen of Hong Kong. This is the China Show. Good morning. All right. Could be a party going on here right now across these markets, and it looks like the setup to China is looking pretty good as well. We're up about a third of 1% on futures here, as well as the strength in the currency coming back here. We're just around that 720 level, Dave.
Yeah, could be a party, likely going to be a party. Looking at equity markets, we're looking at some of these junk dollar bonds, for example, that have, are certainly going to benefit at least from the news flow coming through in the property space, and certainly that's after our scoop yesterday. And some of these property stocks, and our scoop effectively was, and just to recap that in case you missed it, so sources are telling us that there is a plan, at least some talks in place here, for local governments to buy unsold homes at steep discounts from distressed developers using loans from the state banks. Lots of players need to get involved. It's a complex plan, but if it happens, how big of a deal would this be in terms of shifting the direction of this massive ship? Let's get analysis, on-the-ground analysis, in fact, here from Yuan, head of property research at Centaline Group, joining us today. Good morning, and thanks for joining us on the shows.
Good morning.
I wanted to start off with your reaction to if this is the option that policymakers take to buy up unsold inventory. Does this change the story fundamentally, in your view?
Yes. If that really happens, it will be a significant change of the real estate policies, because there has never been a similar policy before. And the developers whose projects are acquired will be directly benefit from this policy. But I don't think this policy can change the overall supply and the demand situation, because the inventories after the acquisition is still the inventory on the market. And we did a calculation till the end of last year.
Tell us a bit more about, go ahead.
Yes, till the end of last year, the whole country's new housing inventory was 1.9 billion square meters. And if you want to reduce the whole country's new housing inventory go to 18 months level, based on the current market price, it will cost about 6 trillion RMB. Yes.
Okay, 6 trillion is no small number, Liu Yuan, as you know. How do you think this is going to be funded then? I mean, is it going to have to be something that's just a half or a full ownership? I'm just wondering, what's the best case scenario coming out of this, and without adding too much of a heavy burden on debt levels for some of these local governments?
I don't know the detail, because so far we just know the news that the government is planning to do so. Maybe the money will come from the central government or come from the banks, and lend the money to the local SOE companies to do the policy. Yes.
Understood. Okay, let's then talk about, I guess, operationally how this potentially could work. Say the government does buy up this inventory. It's almost like a cash transfer to developers. How, correct us if I'm wrong, how easy or hard would it be then for the government to then distribute that as affordable housing? Because you're in the industry. Just talk us through the challenges there.
Yes, there's challenges, because the biggest amount of the inventories are in those rural areas, not so good. The market is not so good as cities. So even after the acquisition, it will be difficult for the government or the local SOE companies to deliver the acquisition properties.
Okay. Overall, I mean, so you're saying basically we still need to get details of the scale of all this, how it's going to be enforced. That's certainly one thing. What are you seeing currently on the ground when it comes to tier 1, tier 2 cities. Are we starting to see a little bit more of positive sentiment in the new housing market, or is that still pretty sluggish?
After the latest round of the housing purchase restriction policies loosening, we see some positive signs on the market. For example, we see the customer visiting increase in the past 2 or 3 weeks. And also on the secondary market, we see the asking price has a slightly increase. So these are all the positive signals on the market.
What about actual buying activity? What are you seeing?
The transactions, especially for the new housing market, is still very weak. In the first 4 months this year, for the top 30 major cities, the new housing sales volume is still at the lowest level since 2019. But the secondary market is much better. For the top 30 major cities, first 4 months is the secondary housing transaction volume is at the average level since 2019.
Okay, yeah, we've seen this trend where the secondary housing market seems to be doing very well. I mean, what are your projections, Yuan, then of when this property market can bottom? Are we seeing signs of that yet?
So far, it's hard to say when the market will be bottomed. And I believe with more supportive policies, especially coming from the central government, it will help the market to be stabilized. According to our estimation for the top 30 major cities this year, the new housing sales volume will have about a 10% drop year on year. And the secondary property transaction volume this year will be the same as the last year.
Okay, so we've established that it's in the big cities where we're seeing things picking up. It's in the secondary market of those big cities. I'm now curious to hear your thoughts on, are there specific property developers that home buyers for now have a preference for, just in terms of perception of quality and the ability to finish projects, for example? If you could give us some names, if you could.
So far, I think there's no big difference on the market. Generally speaking, the SOE companies will be a better choice because the customer will believe they will have more possibility to complete the project, will not delay.
Okay. Well, you have a global audience. Everyone across the world wants to know. This is the biggest story, because if China's housing market turns, the global economy turns. Is there anything we missed? What do you think the world should know about the housing market in China right now?
So far, if we only focus on the new housing market, we will see it's very weak. But if we put the secondary market together, we will see actually there's still potential demand on the housing market. The key problem is people currently may be not so confident about the new housing market. People worry about the developers. They will still in big financial troubles. If the government can provide more supportive policies to the developers and make the market's confidence go back, that will be helpful to stabilize the whole China's housing market.
All right, Yuan, thank you so much for joining us, Head of Property Research at Centaline Group this morning. We're taking a look at when it comes to the pre-market, or at least what's set up today for that Hong Kong reopen. It looks like today we're still poised for some gains here. Futures are still pointing about 1/3% to the upside. We're getting those MCY or MSCI ones are getting close to that 2,000 level as well. And that strength in the currency, we're coming off a little bit. We're back to now 721 levels, but that reference rate just crossing your Bloomberg right now, 710.20 once again. Plenty more ahead. This is Bloomberg. All right, this Hong Kong rally just got a little bit more lit. You take a look at what's going on when it comes to the tech stocks here this morning, and that's catch up that we're seeing across Alibaba, Tencent after reporting earnings on Tuesday. So there you go. Same with what we saw in the ADRs, 4% drop for Alibaba. Tencent, we're up to close to 5% gains here right now. Baidu and JD.com are coming up next to report a little bit later on. We're also watching the property stocks just on the back of that scoop that came out yesterday during the holiday as well. Keep in mind, most of these developers are listed in Hong Kong. There you go. well. Sunak China up close to 7% on our reports that China is looking to tackle this housing glut now. Dave, what are you watching?
Yeah, and absolutely. So the equity market's opening up, the offshore bond market ditto. So in terms of the movement we're seeing there, more on that in a moment. So when you look at property, for example, we have the Hang Seng Index and what's under the hood. You don't really have a lot of property in here because these are the biggest and certainly the shrinkage in market cap. What I do want to point out, though, and Yvonne was pointing this out, Tencent is now trading in the early goings at 400 Hong Kong dollars for the first time in about 12 months or so. Interestingly, going the opposite way is Alibaba. So there is an element of catch up in Tencent's case, catch down in Alibaba. We were down 6% in the Tuesday. In the Tuesday session in the U.S., I'm just trying to get my calendar straight in my head. In the Wednesday session, we did see a pop in Alibaba, not enough to close that gap higher. So we're splitting the difference here, 4% lower in Alibaba. Meituan's coming out 3.4%. JD.com is also coming out with earnings as well. A couple of other things. SMIC, so the initial reaction to the tariffs in place yesterday played out in the chip space in mainland China. So that's also playing out, as you can see, with SMIC. Hang Seng Index now 19,300. HS Tech is closing in at 4,100 as well here. So yeah, so this risk rally does seem to be showing up in these Hong Kong equity markets as well. Dollar China, as you can see, the big drop in the dollar just about across the board. Dollar yen's continuing to see some downside right now. That's going to help this specific pair to come up on your screen. So we'll see what happens. We've formed golden crosses, bullish crosses on MSCI China. I think Shanghai Comp, CSI 300 is near. The next one to watch is on the Hang Seng Index. We have the 50-day over the 200-day moving average. So momentum is coming through, although I should also mention, Yvonne, before I toss it back to you, that some of these momentum indicators are indicating that might be a little bit overbought. But we have been overbought for 2 weeks, and we have maintained this level.
I think JPMorgan Private Bank was saying, right, momentum can go a long way in this equity market, maybe even 20%. But what happens after that, right? We've got the open coming up next. This is Bloomberg. It's a risk rally that I think investors have been hoping for, given this US CPI print that we got. First decline in 6 months as well. I'm guessing that print also very welcomed by the Fed here this morning as well. And you're seeing, of course, this relief across these equity markets here, treasury markets as well. Continue to see yields decline here in the Asia session. In Hong Kong, other tailwinds as well. You talk about the tech earnings in store, Dave, and of course, very much in focus, these property stocks.
Yeah, property stocks, property bonds. I think we're up 14% on one of those names, which will show you. That's in about 40 seconds from now. You can start your clocks now and see if I can get that timing properly in my head. Okay, as far as the risk rally goes, as Yvonne is pointing out, right, you have this big push from the likes of Tencent. $400 was the last we checked here for the first time in 12 months. Although you might get an offset from Alibaba, which did see some downside in the sort of pre-market session here. 0.3%. So as things stand in its early goings, it looks like we might be snapping this 3-day decline we're seeing on the CSI 300. Oh, by the way, in case you missed it, China came out with some new rules on algo trading. You have a few months. I think it's effective in October, so just keep an eye on that. There we go, bottom of your screens. 1- and 10-year yields on your screens, 2.3%. We're also getting some upside coming through in some of the small caps benchmarks on your screens. Flip the boards, please. And while we flip the boards, just a quick note on commodity prices. The Bloomberg Spot Commodity Index is actually now at the highest level in a year. Speaking of inflation risks, question mark. Hang Seng Index took a break on Wednesday, 0.7%. HS Tech is now trading at about 41. There we go. As I talked about, Tencent's up 4%. Alibaba, the offset, going the opposite way. We'll talk more about earnings in a moment here, tech earnings as well. Have a look at Hang Seng Property Index, up 2%. Speaking of builders, before we talk about the broader story, Shermao in Shanghai will be delisted, as we understand it, out of the Shanghai Stock Exchange. Shermao Property in Hong Kong is up 19%. No change so far, or no quote? More on this in a moment. Let's have a look at the builder story right now. So you had a big rally on the CSI 300 real estate index yesterday. 5% up at one point. We closed about 2.5%. So we did pair some of that into the close. We're playing some catch-up here in Hong Kong, as you can see here on your screens. In case you missed it, to Hangzhou, one of the districts there has decided to then go through with purchasing some unsold inventory. That goes into the broader story, really, of why these guys are moving up as well. Okay, very quickly. Earnings, I think you have ZTO Express at the very top. There we go. Baidu, JD.com, and JD Logistics are those that are coming out later today. Yvonne, I think we have some breaking numbers.
Yeah, we got some Aussie job numbers here. This is for the April employment print, now rising 38,477 jobs that were added month on month here. So that is better than expected, but it doesn't seem like it was enough to at least keep this jobless rate from perking up. So we actually see the jobless rate now 4.1%, which is a little bit higher than what was estimated there. That's probably why you're seeing the Aussie dollar drop just a little bit on the back of that print here. But it looks like we're seeing at least the labor supply that seems to be growing quite a bit in Australia. You have a rapid rebound in immigration. You have higher participation rates. In fact, that participation rate is at 66.7%, which is in line with estimates here as well. So there you go. That's what we're seeing with the Aussie job numbers here this morning. And it brings us to what we're really tracking here. One of the top stories is, of course, that catch down in Alibaba, catch up in Tencent shares here this morning, and what to expect out of JD.com as well as Baidu a little bit later on here today. Let's take a look at some of those movers that we're seeing when it comes to tech here. Talked about getting 400 for Tencent, which certainly is quite a milestone. Let's bring in our Bloomberg Intelligence senior analysts, Catherine Lim and Robert Lee. They're back again, this team. Catherine, it looks like we're seeing, when it comes to what we saw in Alibaba, what we saw in Tencent, could we see the same sort of diverging trends with JD and Baidu today?
Right, I'm going to let Rob talk about, Baidu, but JD.com, we're not looking at a pretty set of numbers from the company, particularly for the retail business. They are likely to actually forego some of the margins gains. And, that's really coming on the back of the competition that we've already seen coming through from Alibaba when it comes to Alibaba wanting to actually regain market share back from peers like PDD and JD.com. So JD.com got to actually fend off, and they're going to be spending more, hurting their profits as a result.
She cemented the runway for you to come in.
What's the Baidu story going to be?
Catherine and I were on together. As you say, it's very divergent performance from not just stock-wise, but business-wise, more importantly, from Tencent and Alibaba, with Tencent obviously doing substantially better. This time round, though, Baidu, JD.com, or Catherine's already painted the picture for JD with whatever pressures it's under. Unfortunately, I think the same is true for Baidu, because its once commanding leadership in the China AI sector is being fast eroded as Tencent and others rapidly narrow the gap. And I think, again, taking a step back on Baidu, the reality is it's a well-positioned but very low-growth search engine business, so commanding market lead, which is arguably under pressure from other new startups coming into the market. But it invested heavily in a number of fields. Again, I would say potentially overstretching itself. It's in autonomous vehicles, it's in chatbots, it's in mainstream AI. So for a company, a medium-sized company, it's potentially spreading itself quite thinly at a time when the big guys are coming in, and ultimately, as we see in many subsectors of tech, scale ultimately wins out. The way these companies are trying to monetize their AI ventures is through cloud. The leaders within China's cloud space are Alibaba, Huawei, and Tencent, and we think, therefore, those are best placed to profit in the long run. Unfortunately, not Baidu.
Yeah, it's interesting. And maybe you could tell us a bit more, Catherine, about JD's position, right? Is there still room for any surprise, given the fact that, there's going to be retail sales come back, or you got 618 coming up as well?
Well, do you know what? We've seen some initial colors of some positive signs for JD.com. There are 53% owned subsidiary Dada. The on-demand delivery providers actually cited that there's been a doubling of orders via JD's app when it comes to on-demand, orders itself. So that's actually a plus for JD.com. The question mark really is how much did it cost JD.com and Dada to actually get those orders? Now, we're probably going to see more of that, orders growth coming through the 618 Shopping Festival. And, don't forget that this is a flagship event for JD.com. So, I do think that, the top line numbers, the orders growth numbers should be coming in positive. Again, the impact on the bottom lines and the profits, I think that's really where the million-dollar question is.
Yeah. Bringing it back to just the competition, you mentioned the AI space. With the Tencent earnings, we basically saw on the online videos, that was the big standout there. How does Baidu fare in that competition now, too?
That's a good question. I'd say, again, that the way they monetize their search business is through advertising. So I guess there's a broader question with slowing economic growth in China. How much is that affected? Short videos, they don't have a short video offering, so it's probably less relevant to them. But as I said, they've put their eggs in one basket, maybe a broadly spread basket across different subsectors of AI. But as I've mentioned, that earlier lead is being fast eroded. At the latest count, which is some 6 months or so out of date now, in October last year, there were 238 large language AI models in China. At the beginning of last year, how many had you heard of? There were next to none.
Yeah.
So the fact that so many players have come in, almost every company of the 19, 20 companies I look at in detail as part of Bloomberg Intelligence, everyone has a large language model. From large to small, which tells you, again, the technical barriers to entry are very low. So I think Baidu will struggle on that front in the medium term.
Guys, thank you so much. Robert Lee there, and of course, Catherine Lim, unpacking things for us as well. We're going to think of earnings season, so Baidu, JD.com out with earnings later today. Right, also more on the tech story. So we were joined by Goldman Sachs about an hour back, and coming up here, so Morningstar will give their own take on these tech earnings coming through. Chelsea Tam will be joining shows in about, give or take, 2 hours from now. Right, okay, I need to correct myself. So Shermao Property, here's the big story. So about an hour back, there's a headline that dropped that the Shanghai Stock Exchange was planning to delist, or is planning to delist, Shermao on the mainland. That's because the stock actually had been trading below 1 yuan for 20 consecutive days. So that stock is now suspended onshore. It's trading, as you can see here, in Hong Kong, up about 10%.
All right, up next, we're going to speak to the CEO of the world's biggest jewelry brand about their new factory in Vietnam, as well as business prospects in the region. Pandora's CEO is going to be joining us exclusively next. This is Bloomberg. All right, let's talk about Pandora now. This is the Danish jewelry maker looking to increase its crafting capacity by 50% with a new factory in Vietnam. The facility is located about 40 kilometers north of Ho Chi Minh City and expected to make up to 60 million pieces of jewelry a year. That's a lot. The company's CEO is in Vietnam for the groundbreaking, and we're pleased to have Alexander Lacik joining us now exclusively from Ho Chi Minh City. Alexander, it's great to have you in the region, and congratulations on this news. Obviously, we've heard a lot about Vietnam being that major play in supply chains here right now. Can you tell us a little bit more about the thinking behind opening this facility in Vietnam for Pandora?
Yeah, so there are two reasons why we are expanding our capacity. One is obviously our long-range plan suggests that, we will need more capacity going forward. The second one is also a little bit to diversify our production risks, because we have historically been only present in Thailand. We did a big global piece of work where we actually looked at 27 countries. We used 13 different variables when we were trying to figure out where to go next. And in the end, we had two main contenders. One was actually to put another plant up in Thailand, and the other one was Vietnam. So those were kind of the two main options. And given a little bit of diversification need we had, Vietnam was a good option. One of the important aspects of coming to Vietnam is obviously access to craftspeople, trained craftspeople. The other aspect is that we are working with authorities and governments that are let's say, friendly to corporates. And then the third very important piece, obviously, is that there is an infrastructure in terms of logistics that make it easy for us to export products, both in and out of Vietnam. So those were the key factors why we ended up here.
Alexander, David here. If you could then talk about when is this facility going to be up and running completely? We talked about some of the capacity, or at 100% capacity. Just talk us through the timeline and how much this actually adds to your supply chain.
So today, with the existing supply chain, we have capacity, including our partners, to produce roughly 130 million pieces. This plant, when it's up and running, it's going to be adding something like 60 million pieces. So it's a 50% increase in capacity. Today, as you mentioned in the intro, we have the groundbreaking ceremony here in a couple of hours. And from here, it's going to take until the beginnings of 2026 before the first pieces are going to come out of this facility.
Can you give us maybe just the scope of this investment into Vietnam? How large is this investment for you, Alexander? And are there plans to even set up a manufacturing sort of facility in the country or elsewhere now?
So I think, if I'm not mistaken, that it's probably the biggest capex investment that the company has undertaken. So we're going to invest $150 million in setting up this facility, which eventually will employ something like 7,000 people here in the Ho Chi Minh area. Now, beyond that, we haven't really worked out any additional plans. We have another site available to us in northern Thailand as well, so that might be the next one up. So that's probably going to take us for the next 5+ years at least. And obviously, we then need to work on the sales and marketing side to create the demand for all this capacity.
That's important too, I would imagine. Alexander, talked about, since you brought it up, what is demand looking like for, I believe last year you sold just under 110 million pieces. Year to date, how are you guys doing globally?
So in the first quarter, we were up 18% in organic growth. The number we normally talk about is the like-for-like growth, which is more the performance metric, which was up 11%, and that's an acceleration from Q3 and 4, where we were clocking in at 9. So a very strong demand. The difference between the 11 and the 18 is essentially space expansion, because we're expanding our network pretty much across the globe, focusing primarily on North America, Latin America, and then we're starting now to work a little bit more out here in Asia as well.
Can you tell us a little more about the China business? Because we saw in the first quarter, your deliveries actually declined some 17% year on year. And why do you think that some of the key reasons behind that slowdown? And do you think some of these macro challenges that we're seeing in the mainland right now, is that something that's going to weigh on the company for a few years or so?
Okay, so the China business today represents 2% of the group revenue. So it's a rather small part. Now, the flip side of that is obviously that China is one of the largest jewelry markets in the world. So we wish that number to be, quite much larger in the future. We have had a couple of rough years in China. The business declined. And the key reason for that is that the brand was never really properly established in China. If I compare to the other top 20 markets, let's say, we know that the brand equity has been properly established from the get-go, and then 5 to 10 years on, we sit in market-leading positions. That was unfortunately not the case here in China, so we're going back to the drawing board. The good thing here is that we know the formula, so now it's a matter of being patient and investing in building the brand properly. So this journey has begun. It's going to take some time. The macro obviously isn't helping, but to be fair, I'm not really blaming the macro. This is more our own doing at this point in time, at least.
Fair enough. In fact, the macro situation, in that, since you phrased it that way, might actually just help you if in fact it turns. So what would be the targets of this? If I could call it a reset of your strategy there, what are the milestones you want to see for that specific business on the mainland, Alexander?
I mean, there are a couple of different ways to look at this. The most important aspect is that when we speak to the people that we are targeting, that they actually understand what the Pandora brand is about. We are quite unique in the jewelry, in the branded jewelry space, I should say. where we focus more on jewelry with a meaning versus most other brands are focusing on essentially only operating as a styling accessory. If that's not established with consumers, then we don't really have a strong brand proposition. That's the most important thing, because that lays the foundation then to talk about financial performance. Now, of course, we have financial aspirations as well. And I think the first milestone is probably in the next couple of years to get us back to where we were pre the pandemic period, which was around about the 2 billion Danish kroner size. And then we'll see how far we can take it from there.
What do you see in terms of trends, particularly when it comes to gold buying? I know gold's certainly something that's big in China and parts of Asia as well. How does it compare to other markets like you're seeing in Europe and the US, for example?
So I think it's important to understand a couple of things. First of all, we're mainly a silver jeweler.
Right.
But, you know, and there are some statistics suggesting that up to 2/3 of the jewelry market is unbranded. The unbranded jewelry market is also a big proportion of that is people buying gold more as an investment vehicle rather than as a piece of accessory. So therefore, we don't really track that kind of more commoditized side of the jewelry side. It's interesting, actually, that the jewelry market is the last of, let's call it, the luxury categories that has such a big proportion of unbranded revenue. So we don't really track that. We are more kind of trying to build the brand and induce interesting aspects of the brand. And therefore, I'm not so much into the kind of commodity side of neither silver nor gold, to be honest.
Okay, well, talk to us then about lab-grown diamonds. and certainly the reason first I was, when my producers were talking about that, for a while I was like, was that a joke? But then since you brought it up this way, that we need to sort of distinguish the difference between jewelry for investment and, say, jewelry for fashion, for example. Yeah. What role do lab-grown diamonds play? And actually, how do you make a diamond in the lab?
Okay, this is a very interesting topic. So the first thing to establish is that a diamond is a diamond or it's not. There is no such thing as a fake diamond. A lab-grown diamond is just a different way to get to a diamond. So the end product is 100% carbon. Therefore, that's why I say it's defined by its atomic structure. So either it's a diamond or it's not. There are three main ways to get to a diamond. One is to dig it up from the ground where it's been under high temperature and high pressure for a long time. The other one is essentially mimicking that in a lab, so applying high pressure and high temperature. And then the third method, which is where most of the consumer diamonds come from, is a method which, in its layman's term, is essentially you put in a speck of a diamond into a, let's say, a refined microwave oven, and then use microwaves, and then you pump in carbon gas, and then essentially builds up a carbon structure, which is the exact same as a diamond. That's called CVD, chemical vapor deposition. That's the modern way of creating a diamond, which of course then, from a cost standpoint, you're looking at essentially a third of cost, which now comes into the value discussion of diamonds. And obviously, as consumers are realizing that a diamond is a diamond at a very different value proposition, we can see, and particularly in the US, a quite rapid transformation of the diamond market.
Right.
So, let's fast forward 5 or 10 years, I think the market will essentially be mainly a lab-grown diamond market. And then I think the mined diamonds will have to find a different place in the market. But that's my prediction. Let's see how it plays out.
Interesting.
Alexander, fantastic to have you on the show. Congratulations again on your massive investment there in Vietnam. Alexander Lacik, Pandora CEO, joining us there out of Ho Chi Minh. Right, plenty more ahead. This is Bloomberg.
All right, now check out these markets here right now, and we are seeing basically property continue to flourish here today. Take a look at what we've been seeing on some of these Hong Kong-listed developers. The Bloomberg Developer Index is up, close to 9% here right now. Sino-Ocean's up about 41% on the back of that scoop that we had just yesterday about China maybe looking at reducing the inventory glut in the country. So there you go. Double-digit gains all around, seems.
Party on the streets. Broader benchmark looking like this. So there's a property story, there's some of the tech earnings coming through, like Tencent, for example. And separately, there's also the inflation story or disinflation story boosting not just assets here in Greater China, but also just about across the region. So we're not trading on the Hang Seng Index. It's at 19.2 on the regional benchmark, 2-year highs on the global benchmark. Record highs. Does this continue? At least our show will. See you on the other side of this break. This is Bloomberg.
Welcome back to the China Show, Hour 2, and look at the HSI just a half hour into the session and coming back from that Buddha's birthday holiday. It looks like pretty fired up here, although we are still seeing some gains, about half of 1%. But underneath that benchmark, though, you're seeing a lot of outsized moves, particularly when it comes to some of the tech names, also property here on the back of that scoop that we just brought to you as well. So really talking about this, the plans to reduce inventory in China is what's lifting a lot of these developers here this morning and really giving more reason for this Hong Kong rally to continue.
Yeah, in fact, on that we were talking about, there's one district in Hangzhou has actually decided to go on about it, really. So we'll see. We'll see when they do it, actually. So I think they've only decided that they'll do it. They haven't started actually buying some of the apartments there. But that said, we'll talk about property in a moment. Okay, quite a reversal in some of these names here, with the exception of Tencent, which is still holding on to gains, although we were trading in the early minutes above $400. And as you can see, Alibaba's pulling most things down. The two other companies you see on your screens are reporting earnings today, Baidu and also JD.com. And I forgot to mention as well, when you look at these markets, this is a real acid test now for this Chinese equity market rally. Now that everything else elsewhere is also doing well, what will that rotation and preference look like now that there is an alternative here to Chinese markets? We're also looking at some of these other things as well. Property, we just showed you that as well. Asia ex-China is also doing quite well. 1% on the MSCI Asia Pacific at 182. That should actually now take us to the highest level going back to either March or April of 2022. And S&P futures are continuing to see some upside. And as you can see, just about every single market is up. Euro-dollar is catching a very strong bid from about 16 hours back, give or take. And dollar-yen is continuing to see some downside in the Asia-Pacific. That goes into really this risk rally that's taken up most markets to record highs.
Yeah, we talked about the U.S. Basically, you see those futures are above 5,300 here right now. We basically broke that overnight on the back of that US CPI print. But we're talking about records basically on all. This is just a partial list, right? You mentioned, but basically most of the U.S. as well as European indices basically reached those records overnight as well. So certainly it gives a bit more fodder for these risk assets here and how much more we can see in terms of upside. Let's hear from some of our guests on Bloomberg Television reacting to that latest CPI print.
Inflation it's taking its sweet time coming down, but we still think it's a downward trend.
The big picture on a core basis is that the rate of inflation has come down a lot.
Really great set of data, I think, for the Fed, especially on the inflation front.
This, to me, is a chair who wants to cut. I think that, and you can easily see one, and I think if he has the opening, I think he'll do two. And I think data like this, if it persists, I think that'll give him that opening.
I don't think July, but I do think September is possible.
We need to see more weakening in the data, especially on shelter inflation, for the Fed to begin to gain confidence and get comfortable in terms of beginning to ease rates.
The truth is, I don't think that we're heading into a higher for longer environment. I think we're heading into a normal for longer environment.
Yes. For more, let's bring in our MLive strategist, Mark Cranfield. And Mark, we were just asking your team about how long this sort of risk rally can last. Certainly this was a welcoming number for the Fed as well. Investors are certainly liking it. But how long could these good vibes continue?
a very long time. But I think David made a very interesting point about the fact that it's coming together for developed markets actually might be a slight disadvantage here for emerging markets who've had a pretty good run in the past couple of months. So if you look at really the CPI from the US was the final piece in the jigsaw for the G10 world. So now the ECB will be fully confident to go ahead with their rate cut in June. Bank of England are likely to be pretty close behind. They won't have to wait too long after that. We've just had employment data from Australia, which pretty much guarantees that the RBA will need to go before the end of the year as well. So you're going to have even more G10 central banks all aiming in the same direction. Even if the Fed delays to the fourth quarter, it isn't going to stop the momentum you're seeing in the G10 world. That's very important because those markets are already doing pretty decently anyway. They're huge. They attract vast amounts of capital, and they've got strong currencies together with it. So certainly if you're a global portfolio manager, that CPI data from the US probably just tells you, okay, it's time for me to shift a lot of weighting back into major markets if I'd move some into emerging markets. So actually, you could be onto a very strong point there. This could be a tipping point. It's good overall for global markets, but actually it's probably better for the developed markets than anybody.
Yeah, Mark, speaking of developed markets, and by the way, thank you for the hat tip there. You know who else slept well last night? Japanese FX officials. Have we peaked in dollar yen? Does it cement that peak in dollar yen at 160?
They're still sleeping. They're lying in this morning because they had a great night, as you say. 160 is history. It couldn't have worked out better for them. And the really encouraging thing is, of course, is that whatever implications there are for lower interest rates in the United States or for Europe or anywhere else, it doesn't change the outlook for the Bank of Japan at all. In fact, if anything, this should embolden them to do another small move at the June meeting in a couple of weeks' time, because that would really endorse the positive aspects for the yen. And you can see already dollar yen is a bit lower as it is. But if the Bank of Japan sticks with a little bit of a hiking path, most people expect to July, but if they surprise with a small move in June, the yen could really gain some traction. There's a very good chance now that 160 dollar yen is going to be the high for the year. Could be the high for a long time because the interest rate cycle is going to go way into 2025. People will be pricing for more US cuts going into next year as well. And Japan may not be finished either. So, yeah, a very, very good night for the yen, for Japanese officials, and there's probably quite a way for it to go yet.
Mark Cranfield, thank you so much out of Singapore for us. Right, more good news coming through. We have a Bloomberg gauge that actually tracks dollar bonds, junk bonds to be more specific here. And these are mostly, well, these are Chinese, issued by Chinese issuers, mostly Chinese developers. And it actually doesn't show it here on your screens, but let me just tell you, it's actually now at the highest level here since 2021. There we go. So more on this property story that keeps giving. Okay, more on this in a moment. Let's pivot back to major markets right now because that is still the preference of JPMorgan Asset Management. To unpack that call is Sylvia Sheng joining us here on set, Global Multi-Asset Strategist. Nice to see you. Good inflation print. Major markets still US, Europe, equity market-wise?
Yeah, we still think the fundamental support is pretty strong. If we look at the growth momentum, we're actually seeing a turning around in the European growth numbers as well. So overall, global growth backdrop supportive. At the same time, we are likely to get the monetary policy easing that is likely support risk assets.
So what are your preferences in terms of equities now? Is it still just within the DM space? What do you like?
So we still like US, Europe, and a little bit of Japan as well. So we do think all of this do have a pretty strong fundamental support. Clearly, Japan today's GDP number not that strong, but we do think as the wage growth starts to filter through into the economy, there's still more momentum there.
There's a big earnings print next week out of NVIDIA, and a lot of people are looking at that as, I guess, lots of makes or break moments for this market. But is there a number ugly enough there that could make you change your call? Or is there a broader story now that supports this U.S. equity market that NVIDIA might not matter as much as it did in the past?
I think the fundamental point really is earnings growth needs to be strong enough to justify the high valuations. I don't think it's just stock specific, but just the broader market. We just need to see the earnings coming through. And that's what we have seen mostly in the Q1 earnings season. That's why we still remain positive.
Okay, so you're still going long on these equities. What about when it comes to fixed income? What sort of exposure should investors have now?
So when we look at fixed income now, we still have a preference for U.S. high yield, given that we think recession risk in the U.S. is relatively low at the moment. Yes, credit spreads at historical heights, so we're not really seeing much room for capital appreciation, but that overall carry is still attractive for us.
Treasuries, or have you just answered the question that it's really high yield where the best value is?
Yeah, so Treasury overall duration view, we're relatively neutral right now. Yes, we had a good inflation print, but we still think the uncertainty in terms of the timing of how fast it comes down still there, and growth seems to be a bit more resilient than what people expected. So more neutral there on duration.
In terms of other asset classes, I mean, what else are you looking at in terms of, obviously, we talked about 60-40 not quite working. Are correlations still going to be quite broken for the rest of the year?
Yeah, I think recently, if you look at what's been happening, still seems to be positively correlated. The stocks and bonds are clearly a challenge for us, multi-asset investors. But we do think as inflation comes down later with that loosening of labor market conditions, we could see that tilt back to negative territory.
What are the questions you're getting now on China? I want to ask you about that, because the rally is obviously still taking place, I believe.
Yeah.
But now you have the U.S., of course, as an alternative to your point. What queries are you guys fielding from clients these days?
Yeah, I think it's more a question about the sustainability of the rally and how much of that is fundamental driven. There were some questions about whether it was just a rotation from other regions in Asia into China. But we're seeing more positive policy news, which we think could be a catalyst for further upside.
So what would cause you to maybe shift a little bit out of maybe DM into China now? What else do you need to see?
I think we also need, the dollar is very important. With a strong dollar, it's very difficult to really get back into EM. I think if we have some expectations of dollar starting to weaken as well, I think that would give EM a bit more support.
The inflation story, is that over, or does that remain a risk? Because we've heard on the show recently, strategies like inflation protected, for example, strategies might still have a good place in portfolios these days.
Yeah, I don't think we can quite call it over yet, given just one print and that's in line. I think longer term, when you look at the fact that labor market is loosening, labor demand is coming down, we're still confident that this inflationary process will continue, but the timing is uncertain. I think that's the question here.
What do you think could be the big thing that derails everything, right? I mean, we're seeing all these risky assets kind of rally in the back of one print on inflation. What's the biggest risk you see for the rest of the year?
I think if inflation actually doesn't come down and is sticky, or kind of even worse, if it reaccelerates, I think that will kind of throw a lot of the current positioning into question, whether we're actually seeing that loosening of financial conditions.
All right, Sylvia, we'll leave it there. Thank you, Sylvia Sheng there, global multi-asset strategist at JPMorgan Asset Management. Still ahead on the China Show, our exclusive interview with Indonesia's President-elect Prabowo Subianto, who tells us about his incoming government's ambitious growth targets.
I'm very confident we can easily achieve 8%, and I am determined to go beyond. I would say within 2-3 years, yes.
Welcome back to the China Show. Here are some of the big stories we're following from around the world. The U.S. will send a delegation to Taiwan for the inauguration of President-elect Ching-Te. Washington says the visit is in keeping with its long-standing practice of sending former officials to support a democratic electoral process. Li's election this year was a setback in Chinese President Xi Jinping's ambitions for more influence over the self-governing island. Singapore's new Prime Minister Lawrence Wong is warning of a riskier and more violent world as he officially takes the helm of the city-state. Wong says Singapore should brace for new realities as great powers compete to shape a new global order. He says Singapore will continue to engage with both the U.S., its largest foreign investor, and China, its biggest trading partner.
Let's stay in Southeast Asia. So Indonesia's president-elect says he wants the country to become the world's fastest-growing economy early in his term. Speaking exclusively with Bloomberg in Doha, Prabowo Subianto told us about his priorities when he takes over in October from Joko Widodo.
I'm determined to build on that foundation, and my core focus will be first on food security. Indonesia must be self-sufficient in food, and then energy security, energy self-sufficiency, and we are determined to bring down poverty in a massive campaign, massive effort. I'm determined to get rid of hunger amongst our people, especially the young. And in the end, we have to concentrate on processing our natural resources. We have to make a great effort in downstreaming and to industrialize. And all of this needs good governance. I'm determined to cut down corruption, waste, and with that, we are very confident, we are very bullish, we are very determined to bring this all about.
All very ambitious if you want to do it within your first term, which is 5 years. Can you achieve a growth target of beyond 5% in order for you to fulfill what you've set out to do? In my conversation with Bapak Joko Widodo, he said that he's laid the foundation, he's implemented all the policies, put in place infrastructure needed for Indonesia to grow at 7%. Can you achieve 7% or more in the 5 years of government?
I'm very confident. I've talked to my experts. I've studied the figures. I'm very confident we can easily achieve 8%, and I am determined to go beyond.
8% within the 5 years, the first year, second year, and when you go beyond, are you looking at double-digit growth?
I would say within 2-3 years, yes.
You talked about downstreaming. What are the other growth drivers for you? Or would downstreaming be key to you achieving 7, 8, 9% growth?
Downstreaming will take several years. What will be a growth driver in the first years will be our concentration on agriculture, food production, food distribution, and energy. We want to go green in a very quick way. We want to produce our diesel from palm oil, and this will be a very strong growth driver. You know, we import $20 billion every year for diesel oil. So can you imagine the savings we will have when we will switch to biofuel?
I want to touch on your spending plans. When you campaigned, you talked about how you want to provide free lunches, free milk for students, and some are questioning how you will pay for such a program. Can you fund that program if you're unable to perhaps raise the limit of your budget deficit beyond 3%? You've said you can.
We have studied this. We have, what do you call it? We studied all the figures, and we are very confident we can do that. We are very confident we can do that. And
while keeping your budget deficit at 3%?
Yes, 3%. And you know, the 3% is something arbitrary. Not many countries hold to that. But we have a tradition of prudent fiscal management. I think we have the lowest debt to GDP figure in the world, one of the lowest. And so now I think it's time to be a bit more daring within good governance.
That was Indonesia's President-elect Prabowo Subianto with, of course, our colleague Haz. They do have a rate decision, by the way, in Indonesia next week. More on that in a moment. But before I just talk about Southeast Asia, very briefly, 10% rally now in property stocks about an hour into the session. We'll have more deeper dive really with our analysts, in-house analysts, on what this means, this latest round of measures on that in a moment. Pivoting back to Southeast Asia, just very quickly. So Indonesia, we were pointing this out here, one of the weaker currencies, but the weakest currency, worst performing currency this quarter in Asia Pacific is the Philippines. We're down 2%, worse than the yen. So speaking of central bank decisions, we have one from Indonesia next week. But ahead of that, later today, of course, Yvonne, we do have one out of the Banco Central.
Yeah, and we got a big conversation tomorrow on the China Show. We're speaking exclusively with the governor of the BSP himself, Eli Remolona. He's going to be joining us at the 9 o'clock hour Hong Kong time. We got plenty more ahead, plenty to ask him, not just on the currency, but really outlook for policy the like. This is Bloomberg.
Welcome back to the China Show. Some big corporate headlines that we're tracking for you at this point in time. Bloomberg has learned that HSBC is leaning toward appointing its next CEO from a short list of internal candidates. According to sources, the lender sees the CFO, Georges Eldery here, as the and wealth and personal banking head Nuno Matos as leading replacements there. The two leading replacements are Noel Quinn. We're told HSBC has engaged an external recruitment firm to benchmark them against external candidates for that specific role. Now, some shareholders in BHP and Anglo American expect the takeover saga to continue. Now, they've told Bloomberg that there is room for a sweetened third offer for BHP before this deadline that looms on May 22nd. Anglo has rejected BHP's previous all-share approaches and announced a revamp that includes exiting diamonds and also platinum and also exiting coal. Now, Paramount is said to be, or at least is said to have had discussions here with Amazon about expanding ties between their media businesses. Paramount has been struggling with falling ad sales and a money-losing streaming business. It's fielding takeover offers from independent producer David Ellison, as well as an approach, perhaps, from Apollo Global Management.
Yeah, we're taking a look at markets here this morning, and we continue to see this extended risk rally across the board, but we're focusing a little bit more on some of these Japanese lenders. So it seems like, that GDP print certainly was weaker out of Japan. That did lead to some of these declines and maybe overshadowing some of the speculation of a BOJ hike as well. In terms of each lender, MUFG shares are declining here this morning, down some close to 5.5%. There was a smaller than expected buyback program. Also, you look at the likes of Mizuho as well. Their full year guidance was actually beating estimates, but we're actually still seeing the stock decline about 2% here right now. The Topix Banks Index also is heading lower. Watching some of these biotech shares as well. So we're hearing a little bit more about this bill. So House panel okaying this Biosecure Act as well. So we are seeing a little bit of a downdrift across the likes of Wuxi AppTech down some 2%. China Medical also down 4% this morning. We're also watching Singapore Airlines. So that one's down some 2%. So there's reports of a fall in staff bonuses. That's certainly why the stock is slightly lower here this morning. And Taiwan Semi continues to gain. We're off some of the highs that were up about 0.8%.
Yeah, an update here from the company. So we were talking about this explosion that was reported earlier on at its North Phoenix plant. So the company did confirm there was an incident in Arizona. There was no damage to their facilities and no TSMC employees and on-site workers reported injuries. That's the latest there out of the company. Right, going into about an hour into this Hong Kong and mainland China session here, and it's a rally that's taking place quite strongly, as you can see on the Hang Seng Index, although the tech index might have an aberration because that is I would say mostly, but perhaps more exposed to Alibaba. But that said, properties rallying hard, 3%. Hang Seng Index is 0.5%. To the upside, every single stock that is allowed to trade or that is not halted on the property gauge is actually rallying quite substantially now on the Bloomberg property gauge. And, normally we don't talk about the Hong Kong dollar, but this dollar weakness has in fact been so pronounced that even the Hong Kong dollar is gaining. And at these levels, the lowest level here since January on this exchange rate. Right? We're about to go big in Hong Kong because of this. This is Bloomberg.
All right, 11:29 a.m. in Tokyo. We're seeing Japanese markets heading to that lunch break, and you're seeing a bit of divergence between what the Nikkei and the Topix is doing. In fact, you're seeing Nikkei actually doing quite well and joining in on this risk rally. We're up about 0.8% there. Dollar yen, right? What did Mark Cranfield say? Say bye-bye to 160. That probably was the peak for dollar yen. Of course, on the back of that US CPI print, which really led to the drop in that dollar. So 154 levels right now. We're continuing to see some strength across when it comes to yen. And even yields, JGB yields, are heading down this morning. Here we're down some 2 basis points for your 10-year yield. So we didn't quite get to that 10-year high for the 10-year.
No, we were almost there.
Almost.
Yeah. In fact, we already ready the script for you guys. That's how we work on TV. But as fortunes would have it, there we go. A turn as far as that's concerned. For the good, I guess, for most, if you're long these markets, because a yield means yields pulling down. Equity markets are rallying 1%. S&P futures are coming off highs a little bit, but still higher for the day. But as you can see, it's one caller, really, with the exception of one. But that I would imagine that is actually down to Alibaba, that specific tile consumer discretionary. I could be mistaken. I'll look at that in a moment. But almost every single sector is higher, and we're paying particular focus to property. And we're up about 9-10% on the Bloomberg gauge. Just keep in mind Wednesday was shut, so there is an element of catch-up here. And catch-up is exactly what we are seeing. Now on this Bloomberg scoop, here are some of the views that we've heard so far from our guests on this potential plan from China. Have a look.
If that really happens, it will be a significant change of the real estate policies, because there has never been a similar policy before. And the developers whose projects are acquired will be directly benefit from this policy. But I don't think this policy can change the overall supply and demand situation.
Who is going to fund it? If they are just going to ask the local government or the state banks to fund it, maybe these guys may not be willing to do so.
For the banks, they're a little bit reluctant because they're already purchasing a large amount of the central government special purpose bonds. And when the interest rate goes up, there's definitely going to be mark-to-market losses for them. So how much more willingness the banks are going to do the national service.
Yeah, so it seems like there's still a lot of questions left after that story broke as well.
It is a big job to do.
Yes,
right?
We still got a lot of questions to ask. Let's bring those questions to BI's China property analyst, Christy Hung. Christy, you've been able to look a little bit more on this report. How feasible do you think is this plan?
Right. So look at some T2 cities like Taihe and Harbin. If you look at that new home inventory, that's covering 11 to 16 years of sales.
Wow.
And that is how much inventory there is in the system. And if you think about asking local governments to absorb such sizable backlog, it might not be very realistic. And at the same time, it's not the best use of resources. Think about converting those into affordable homes. We probably don't need that many affordable homes in China, given, shrinking population.
Have we been able to map out at least what the hit to revenue would be? I'm not sure if I'm phrasing that properly, because the part of the plan is they will buy some of the units at a discount from distressed developers. So there's a lot there, right? You have to pick who distressed is, and then you have to figure out how much you're buying it for. Is that a good or a bad thing for some of the distressed developers, is what I'm trying to get to?
Right. So I think it does help them to purge the inventories. But I think my bigger concern is a lot of these inventories actually lies in lower tier cities in China, where the local governments have weaker fiscal capacity. So do they actually have the fiscal capacity to conduct such kind of purchases? Think about low tier cities in China. They haven't been able to sell land in the past 2-3 years, and that's also cutting off a major source of their revenue. And if banks are looking at these local governments, are they willing to, and are they confident in lending to these deals to support them?
What about the second-hand home market? And what do we look in terms of supply there?
Yeah, so I think, this policy looks at purchasing new home inventory, which is a good thing. But don't forget, we have very sizable second-hand home supply in the system. And, if we're looking at second-hand homes this is the very reason why this downturn is very different versus 2015. We have a lot of secondhand supply, and in 2016 to 2020, China sold 9.6 billion square meters of new homes, and that's equivalent to 47% of all the new homes sold in the past 2 decades. And a lot of people who recently bought a new home, they're now thinking about offloading it into the second-hand home market because of a change in home price expectations. So buying new homes from developers is a good thing, but having sizable second-hand home supply remains a roadblock to achieving that supply-demand balance for the housing market.
Christy, fantastic.
Yeah.
Thank you so much. Christy Hung, our Bloomberg Intelligence China property analyst. Just ahead here in shows, we're shifting gears from property to Putin. There we go. Russian President Vladimir Putin has arrived in China. Quite an early touchdown. 4 a.m. local time, based on local reports here. His first foreign trip off his new term. Einar Tangen joins us shortly for some analysis. This is Bloomberg. Russia's President Vladimir Putin landed this morning, early morning local time in China, for a 2-day state visit. It is his first foreign trip since the start of his new term, highlighting the importance of the relationship with China following Moscow's invasion of Ukraine.
Yep, the trade ties between the two have grown rapidly this decade. Take a look at this chart. Basically, when you talk about China imports from Russia hitting a record in March, April's trade data also showed a 17% increase from a year earlier. Let's get more on the relationship with Einar Tangen, senior fellow at the Taihe Institute, a Beijing-based think tank. Einar, obviously this is the Russian president's first trip since he secured that 5th term. He chose China. Tell us what do you think is going to be in store and what he's trying to achieve.
Well, he wants to further the economic relationship. Obviously, he would like to press for some sort of help with Ukraine, but I don't think that that's necessarily in the cards. If he can walk away with this, with more assurances and agreements to increase that amount of trade, it'll be very good. You know, if you start looking at the numbers, you'll see quite clearly that the amount of trade with China is double the amount that was lost with Europe. So Russia continues to grow. In fact, this coming year, it will be growing at a much higher rate than Western countries. China will be at 4.9, Russia 3.2, US 2.7, UK 0.5, Germany 0.2, France 0.7. It's a hard narrative to fight.
Where do you think the peace process, or at least the notion of a peace process, comes into play in these discussions? Because we know, of course, what China's position is specifically on Ukraine is de-escalating the situation. How do you think that plays out, that dynamic plays out, Einar?
Well, you know, I think there's been some choreography here in terms of the trip to Europe. This actual meeting was in the works for quite some time, so I would say that it was perhaps the European side that was choreographed. China wants to see peace as soon as possible. The difficulty here is trust. Was real problems with Minsk 1 and 2. Both Hollande from France and Merkel from Germany admitted afterwards that they had no intention of following through with the agreements that they signed. They were just simply playing for time. So that makes it difficult to bring people together. China is not trying to impose a peace. They simply want to set the table. Russia and China obviously differ from Europe and America in terms of how that should be. Ukraine is insisting that as a precursor to any negotiations that Russia basically has to leave. That's probably not going to happen. China is trying to strike a midpoint by saying, look, you two have to get to the table and start talking about this.
So what are those limits then to this no limits partnership, Einar? Is it purely something that is transactional? You talk about the trade relationship, or do you think that there is some sort of real relationship here between the two countries?
there's a relationship. There's always issues of trust. They've had things in the past. But quite frankly, with the way that the world is set up, with both of them feeling under pressure from Washington, this is probably going to continue over the long term. Remember, Russia is #1 in the world in resources. China, #1 in manufacturing. They have a very long border that cannot be interfered with by any other country. They represent, to some in Washington, an existential threat to U.S. economic hegemony.
And is that what Russia offers China? I mean, apart from looking at this specifically from a bilateral perspective, what is the big picture? I can see what China offers Russia. It's more difficult the other way around. If you could just
what's in
unpack
it for
us.
China?
Yeah.
Yep.
Well, a tremendous amount. Russian resources, for one, and a country that spans 11 time zones that brings them to Europe, the Middle East, through the stands, etc. They would form a cornerstone to a very, very, big counterbalanced to U.S. and EU. Remember, the rest of the world, which seems to be, the area where both Russian and Chinese trade is expanding, far exceeds in terms of markets, population, landmass, production, that of the developed world, Europe and the United States.
And of course, you mentioned about the United States. We learned this week that they're imposing these tariffs on everything from EVs, critical minerals, syringes, the like. Einar, your take on this, and really, do you think China's going to respond in any way?
Well, economics have become a tactical and strategic tool to bring about political change. This is a little bit different from the traditional U.S. approach, which was to bolster economics and to use politics to do that. So you're seeing a kind of reversal there. But, the difficulty here is you don't see a big end game containing countries like sanctions and tariffs. They're great tactics and strategies. The only issue is how do you keep this up forever? There's got to be somewhere where you're aiming at something, and it's not always necessarily apparent from the U.S. side. Plus, there's this issue of predictability because of the way that the elections swing back and forth. I can tell you this, to your earlier question, what are the limits between China and Russia? Very simply, militarily. China will not get involved in any kind of access or alliance, defensive or offensive, to help Russia or any other country, wage some sort of conflict. And this has been very, very clear. The difficulty for China has been that they have two countervailing principles. One is this territorial integrity, which obviously is about Ukraine. But on the other side, they have this sense that all countries need to be secure. And they understand from their perspective that Russia has security issues that go very deeply and involve Europe and the United States.
Yeah, and that's a fairly complex one, and that leads us into a different path of conversation, which we probably don't have time for, but I'm glad to bring that up a different time, Einar. But just simply back to, we're waiting. I'm not sure if that's the right. Are we waiting for Beijing to respond to U.S. tariffs? And you brought it up. It's an election year. And I'm wondering whether, the U.S. is simply using economic tools to further domestic politics as far as the Biden White House is concerned. And I'm wondering, what is the view on the ground in China? Do they have to respond in kind to these tariffs, you think?
Well, I think the learning curve in Beijing has been fairly steep, but they now realize that, Biden is pushing the political panic button. He trails Trump by 7 points when it comes to the economy and the people's minds. And right now, despite the somewhat rosy projections put out in terms of the numbers, the vast majority of Americans are not feeling great. They feel that, the economy is slowing down. Job opportunities might be plentiful, but they're not the kind of job job opportunities that they keep them in the style to which they wish. There are a whole host of issues out there. So, at this point, China is just going to wait and see. Think of it as a very strategic move. They do not want to, dispel this notion that they're welcoming FDI. At the same time, they probably will respond. Look for something in agriculture where they can reward those countries who are willing, like Brazil, to trade with them versus the United States, who is not.
Einar, we're going to leave it there. Einar Tangen, there, senior fellow at the Taihe Institute, joining us out of Beijing. Lots of commentary on geopolitics in some of these China state-run English language news outlets here today. Here's your China brief. The Global Times warning that the Philippines against stoking tensions in the South China Sea and saying that Beijing's goodwill and patience are not limitless. That's after a group of around 100 Filipino activists, fishermen, and journalists set sail for disputed waters this week. The paper also covering Putin's visit by highlighting his comments about China's stance on the war in Ukraine. Now, the article quotes that China's ambassador to Russia, who says that Moscow and Beijing will never accept threat of sanctions, using Ukraine as an excuse to interfere in their cooperation. Putin's trip also among the top trending topics on Weibo this morning. Most users are reacting positively to news stories about this visit, with comments saying that Putin is a, quote, great fighter in this battle against the Western world, and that China-Russia ties are conducive to world peace and stability. Now, there are some on the other side of this discussion, negative comments as well. Some saying, what has China brought to the world in the last 20 years? They have basically invited international sanctions, and Russia has something to ask from China, so act modestly while here.
Yeah, meanwhile, in financial papers, lots going on, in fact. So this is on the market and the economy. So Shanghai Securities News reporting today are citing analysts in their report saying that there is no urgency for cuts as far as the RRR or interest rates over the near term. Now, the analysts say that is because of ample liquidity in the financial system and also the strengthening in the Chinese economic recovery, according to that report. Now, the Economic Daily calling for stronger supervision of hedge funds following an investigation into Zhejiang Weifangda, that's asset management. Of course, there it says illegal activities at hedge funds have shaken market confidence. And in the Securities Times, the report here says that China's new rules, and new rules are coming in play by October, on algorithmic stock trading will improve pricing, transparency, and reduce volatility. The new CSRC regulations, to the point we were making earlier, will take effect on October 8th. There we go. That's your China brief for this Thursday. This is Bloomberg.
Welcome back to the China Show. Here are some of the big stories we're following from around the world. The U.S. says it's accelerating arms supplies to Ukraine as the country's military confronts a Russian assault in the northeast. Russian troops are pushing deeper into the Kharkiv region, taking control of some villages close to the border. The offensive is stretching Ukraine's forces and may push Kyiv to redeploy units from the front line in the east. Slovakia's Prime Minister Robert Fico has suffered life-threatening injuries after being shot in public. It's the first assassination attempt on a European leader in more than 2 decades. The 59-year-old was in hospital in a very serious condition following the attack by a gunman who police say had a clear political motivation. Fico returned to power last year as a force of opposition to EU institutions in Brussels. The U.S. has warned Israel it risks creating a power vacuum in Gaza, urging the country's leaders to focus more on post-war planning. Israel's gradual deployment of troops into Rafah appears to be the start of a full-blown invasion of the southern Gaza city. Secretary of State Antony Blinken says the U.S. is worried about the blocking of aid for the Palestinian territory.
One of the deep concerns that we have is the impact of this limited operation that we've seen to date in Rafah on the ability to provide humanitarian assistance, because the 2 main points of access in the south, Rafah itself and Kerem Shalom, have been affected by the resulting conflict.
A standoff is underway between police and protesters at the University of California Irvine campus that's south of Los Angeles. TV pictures are showing officers reported to be from multiple law enforcement agencies dismantling barriers set up by the protesters after a campus lecture hall was occupied. Universities across the U.S. have been calling in police to break up pro-Palestinian protest encampments set up to call for an end to Israel's assault on Gaza.
Right, just looking at markets right now, it's just about a sea of green out there. Wow, it's rare that we see this. And you're looking really at just this is what happens when the inflation story and markets hear what they want to hear, right? So you're looking at really the dollar continuing its weakness across the region. Equity markets are bid. Volumes are, in fact, coming back. I'm going to give you a number in a moment here. Yep, so we're just about a little bit above your 30-day average as far as volumes go. Every single sector just about is up across the region. Bonds are also catching a strong bid. We were down about 8 or 9 basis points on the treasury across the curve, in fact. 6-week lows, everything from the 2 all the way up to 30-year yields. More in commodities in a moment. FX markets, more in that and more specific level to tell you about. The dollar had its worst day this year. We're back on the 200-day moving average on the Dixie index. Euro, you have dollar yen on your screens, and also, of course, cable. So some weakness coming through still in the U.S. dollar. Commodities are a big topic of conversation today. So the benchmark is actually at a high, 1-year high. And there's some interesting subplots within the copper story.
Yeah, there's a bit of a short squeeze in the New York contracts, and you're seeing quite a bit of a gap between what you're seeing in New York and in London, right? Yeah. But even the LME contracts are rallying some 1%, and I believe we're pretty close to the records that were set about 2 years ago. Yeah. We're at that 10,300 level or so. So certainly copper's catching a bit. We talked about gold futures. They're flat right now, but basically they've been climbing since this US CPI report. And Bitcoin, we're at 65,000 change.
We did see a big pop in Bitcoin going into these levels right now. So it did act like a risk asset. It did not act like an inflation hedge, as some people were advocating before. But anyway, that's what a chameleon does, doesn't it? It adjusts to preference and narrative, as they say. Futures, so it's looking like it's going to be another good day as we approach the Middle East, European, and U.S. markets yet again for the Thursday session. So record highs just about across the board, across DM, S&P, Dow Jones, NASDAQ. Pick your benchmark in Europe, Euro Stoxx 50, Euro Stoxx 600, the CAC index, the DAX, the FTSE 100, all at record highs. IBEX is at about a 7 or 8 year high. And I think the other one, the FTSE in Italy, is at about a high since 2008, I believe. But yeah, there we go. So it's been good.
We're not done with the week yet, right? We still have activity data tomorrow out of China.
I forgot about that. This time tomorrow.
This time tomorrow.
Yes. Okay.
If you take a look at what April is going to look like, are we going to start to see a little bit more improvement in this two-speed economy, or is it just going to be industrial side that continues to outperform? Consumers still looking like it's weak. Maybe that's what Bloomberg Economics thinks too.
Yeah, and we'll see, because analysts are looking for anything to latch on to take this rally even further. We're up now 30% on the Hang Seng Index. Earnings are one story, and tomorrow you have eco numbers as well. That's it from the China Show. Plenty more ahead. This is Bloomberg.